2 days ago, the market cap of Bank Asya is $1.1 billion, and market cap of Al Baraka Türk is $946 million. Bank Asya has 51% free floating shares, and Al Baraka Türk has 21% free floating shares. There are 48 banks in Turkey. Out of 48 banks, 9 of them are, 9 conventional are listed company, 2 participation banks are listed. Then, if we look at the market cap of the listed conventional banks, it is 96 billion, and 2 billion is the total participation banks market cap as listed company. If we have a look at the number of branches as of June 2012, the total number of branches in Turkish banking system is 10,708. Number of branches of 4 participation banks is 731. Number of personnel is, in the total banking system, it is 197 or approximately 198,000. In participation banks, 14,000 people are working. If we have a look at the development in between 2001 to 2012, although 3,357 increase, there is increase in banking sector, almost half of it is increase in participation banks. You know, you see the participation banks are growing very fastly compared to banking sector. As to branches, 387 branches added to banking sector in this 1 year, 88 in participation side. As percentages, number of personnel in banking sector increased only 1.7%, but in participation banks it increased by 12%. For branches, banking sector increased by 3.5%, participation banks increased by 14%. These are the assets, loans, deposits, profitability, and capital adequacy ratios of the sector and the participation banks compared 2005 with 2007. If you look, the share of assets in 2005, it was 2.5, so 2.4. In 2011, it is 4.4. Loans was 4.1. In 2011, 5.5. Deposits was 3.3. In 2011, 5.4. Again, a comparison with December 2011 to June 2012, assets increased in participation bank 8.7, which is almost double of increase in banking sector. Loans increased 13%, deposits increased by 8.4%. Here you see the graphics of the development. Starting with 2005, in the top left, you see the total assets. 2005 to 2012, you see the trend of the increase. In the right side, top, you see funded credits comparing 2005 with 2012. In bottom left, you see collected funds. And in the bottom right-hand side, you see the market share as assets, as loans, and as deposits. As assets, is it 5.1% market share? In 2012. For loans, 6%. For deposits, 6.2%. I guess in Malaysia it is 20%, isn't it? 25? Yes. Inshallah, in Turkey we will see those days. The calculation of required minimum capital for conventional and participation banks in Turkey are different. In Turkey, there is a special weight of credit conversion factor, different than conventional. In conventional, credit conversion factor is 100%, but in participation banks, it is 70%. If a participation bank and a conventional bank both grants loan to customers 1,000, the required minimum capital of participation bank is lower than conventional bank. You see, in conventional bank, required minimum capital is 80 for 1,000 loan, but 56 for participation banks. This is an advantage for participation banks, but of course the reason behind is the characteristics of loan given by participation banks. Here you see the capital adequacy ratio, which is equity capital over total risk-weighted assets. You see the starting with 2005 to second quarter of 2011, the capital adequacy ratio of participation banks are lower than the sector. This is against to what I say. There was an advantage, but I will explain the reason. Although there is an advantage in calculation the required minimum capital, the capital adequacy ratio is lower. But it is stable. You see, after 2006, it is going stable. Here also, you see the position of capital adequacy ratios for banking sector and participation banks. As 2012, it is 17.8 for conventionals, 13.9 for participation banks. Why? Why participation banks have lower capital adequacy ratio? The reason is the difference in composition of asset side of the balance sheet. Sorry, asset should be double S. The composition of asset side of the balance sheet it is different, as you know, in participation banks. Participation banks do not and cannot keep government bonds, which has zero risk weight. Conventionals keep government bonds around 20–25% of their assets. Share of loans in assets of participation banks are significantly low. There is, significantly higher than conventionals. Share of loans in assets of participation banks are significantly higher than conventionals. Weight of off-balance sheet financing is very high in participation banks. Here, when I say off-balance sheet financing, I mean the guarantee letters. The volume of guarantee letters granted by participation banks are higher compared to conventionals. The percentages are there. Off-balance sheet financing over total assets is around 37% compared to 18% in conventionals. Here, there is an important characteristic of Islamic banks or participation banks in Turkey. Participation banks finance the real sector, grants more credit to real sector. You see here the participation bank real sector credit